we're back on our Minorum YouTube channel interview series here with Thibaut Lepouttre of the CaesarsReport.com. Thibaut, thanks for being here with me on the interview here.
My pleasure, Sonny.
As we've done an interview before, your specialty is in the EuroZone. You're based in Belgium there. About a week and a half ago, 2 weeks ago, the U.S. Fed announced it had stopped QE indefinitely, and the markets reacted very positively, and the precious metals declined, significantly, reaching a range of around 1170 range for gold and $15 for silver. What is this reduction in the QE, and what are the implications that this has on the financial markets?
Well, as everybody knows, the Federal Reserve has started to taper its quantitative easing program, and when it was still purchasing $15 billion per month in treasuries and mortgage-backed securities in September, it scaled it back down to zero in the month of October. So this wasn't really an unexpected surprise, but let's not forget one thing, and that is that the Federal Reserve, will definitely continue to be on the market, because it stated that even though it will not print any new money, it will definitely reinvest the returns and the principal amounts it gets back from its mortgage-backed securities. So the Federal Reserve will still be on the market to support the MBS prices, because otherwise, if you would eliminate such a big participant in the market space, you would immediately see some crashes in the values of those MBSs. And like you correctly stated, the precious metals, there was some influence on the PMs, but let's not forget that the huge crash, so to say, actually only occurred 36 hours after the Federal Reserve announced it would fully stop its quantitative easing program. So that was quite a weird scenario, because if you look back at the charts, the first hours after the decision, gold and silver were down about 1.2%, but it's only 36 hours later, during the Asian trading hours, that the slide really started to occur.
So with this QE, what's the total value then that's on the balance sheet of the U.S. Fed? And going forward, how much are they really, because there's no more new printed QE. So how much are they investing in the MBS?
Well, the total position on the Fed's balance sheet is 4.5 trillion, of which 1.7 trillion is invested in MBSs. So keep in mind that in September the Federal Reserve announced that it would continue to purchase MBSs at the rate of $5 billion per month. But if you look at the hard data, you see that that the Federal Reserve actually added $15 billion. So on top of the $5 billion newly printed money, the reinvestments counted for an additional $10 billion. So going forward, I would think that we'll continue to see the Federal Reserve put in an additional $5 billion per month coming from returns, and on top of that, it will reinvest some principal payments as well. So I don't really expect the 1.7 trillion position to be wound down very fast and easily. It's gonna take several years, I would say.
Interesting. So really, QE didn't really end. It's just that the newly printed QE has ended, but they still have to reinvest that portfolio that they've been building up over these several years.
That's correct. The returns on the newly printed money will continue to be reinvested. So it's no longer an official QE, but it's still. Let's put it this way: the Federal Reserve isn't pulling a single dollar back from the market.
Interesting. And with that, you have the U.S., quote unquote, stopping QE, but then Japan increased their QE significantly and expects to hit 102 trillion yen. Now, what are the implications of their QE program that has increased significantly?
Well, Sunny, the implications will be absolutely huge. If you look at the current currency exchange rate, that's about 700 billion US dollars per year. That's just slightly lower than the 1.02 trillion dollars per year that the US printed on the top of their quantitative easing program. But you can't ignore that the Japanese economy is so much smaller, so the impact will be much higher.
Mm-hmm.
Because if you look at the hard numbers, the 1.02 trillion dollars per year in the US was about 6% of the GDP, while Japan's $700 billion per year is about 12% of the GDP.
Wow.
So you could actually safely state that Japan is actually printing money at twice the rate the US was printing it. So I think you really cannot underestimate the impact of this new round of quantitative easing in Japan. And it looks actually like it's some kind of all or nothing strategy from the Bank of Japan to stimulate the economy and increase inflation.
Interesting. Now let's talk about the EuroZone. They recently went through a bank stress test through a consortium of banks, 130 banks in total, of which 25 had failed the bank stress tests. And now the first Euro bank is now charging negative interest rates to their retail consumers, of which, if you have a balance of 500,000 euros at the Deutsche Skatbank of Germany, which is paying, you have to pay 0.25% per year out of your own pocket. What is the current status of the banking system because of these particular stress tests and this new negative interest that retail consumers will be facing?
Well, the ECB actually called it an asset quality review to avoid the word stress test. But my main problem is actually the timing of the study, because if you look at the data they actually used the balance sheets as of at the end of 2013. And they used that to perform their tests on in October 2014. So the tests were actually fully based on outdated numbers. So most of the capital holes were actually already filled, and some of them haven't been. So it's I would say that the ECB's asset quality review was actually way too late. So, of the capital shortfalls we saw in the official outcome, there were less capital shortfalls than expected. 25 isn't too much. I mean, a lot of market participants would have expected many more banks to fail. And another issue is that the capital holes were much smaller than anticipated as well. So this actually raises the question whether or not those stress tests were strict enough. Was the adverse scenario actually really adverse? Because it was quite surprising to see so many banks, and especially the big banks, easily pass the stress test. So the ECB actually wanted to, how would I say, restore credibility in the banking system of the Eurozone, but it might actually have lost its credibility because the tests might not have been strict enough. So looking at the example of the bank you gave, which forces its customers to pay 0.25% per year, well, okay, it's a retail customer bank, but let's not forget it's about 500,000 euros. So the usual common man doesn't get punished at all, and I would say it's a special thing. It's a surprising thing, but I don't think it'll be the only bank who will be forced to take such measures, because otherwise it won't generate any profits anymore, because as you know, the interest rates are extremely low in Europe right now.
Interesting. So do you expect that maybe some other banks may start to charge more negative interest rates, and more banks will come on board for that?
I wouldn't say that's impossible, but will think, and I continue to think, that it'll only happen for larger amounts of money. So the normal retail customer, which has 25 or 100,000 on the bank, won't really be affected. But for the huge capitals, yeah, I can definitely see that the interest rate goes to zero in some banks, and in some other banks even negative, because it's a different standard between having a lot of capital and just avoiding to punish the common man.
Absolutely. Well, thank you, Thibaut, for a quick sum up on the U.S. and the Eurozone as well as Japan's QE program. Thanks for your time, and we'll look forward to your next update in a couple months on the Eurozone going forward. Thanks.
Thanks for having me, Sunny.